hello, everyone. Today we're here. I want to welcome you to Real Estate Investing Made Simple with LeAnn Riley. And today my guest is Tim Swierczek. Did I do it right?
Yeah. Hey, investors, how's it going? I'm happy and proud to be here today. I'm blessed to know you, and I'm really happy because this is like my third time doing this now with you. So,
It's
I'm
been over a year though. We checked.
yeah.
It's been, and then with the recent fall in rates, it's like we need an expert here. We need someone who understands mortgage. So we're here at Real Estate Investing Made Simple, and we do live interviews monthly with experts and leaders in the real estate investing world nationally. I'm LeAnn Riley. I'm a national real estate coach and a broker, and I help ambitious high performers build a personal roadmap to wealth with real estate investing through our proven profit formula system to get winning cash flow properties. And I use that system to build a $14 million portfolio in residential, multifamily, condo development, commercial, and vacation properties. And today I lead the Encore investment team of realtors in the Twin Cities, Minnesota, and it's brokered by Realty Group. And you can call me or Eric Jansen for help to buy, sell, or invest. And you can find us on leannriley.com. And don't miss out on investing how-tos and education. There's a lot of it out there on my YouTube channel, and that's just called LeAnn Riley Real Estate. So be sure and subscribe if you get over there. Now, today's hot topic, and this has been hot in the last, for sure, week or so because, mortgage rates are a big deal if you're buying a house. And the big thing is, there was a slight drop. So I want to talk to Tim and find out, okay, what's the effect here? And how do we leverage these lower mortgage rates? I mean, hey, they're not rocket science lower, but they're lower. Every little bit counts. Okay. So let me introduce Tim. He is a true real estate entrepreneur and he owns investment property. I love that. He's not just a mortgage guy, right? He gets it.
Mhm.
He's a mortgage originator for over 24 years, and he's currently with Gold Star Mortgage. And he's a mortgage geek too. He's known for his ability to handle complex income and unique customer situations. Really, what that is creative financing. I know I've sent him people, and then it turned out it had to be a commercial loan, but he has a very good resource for that. So it was seamless. The deal just kept marching forward. And that's what you want from a mortgage person. He's also the former president of the Minnesota Mortgage Association. So like I said, he's an expert. So welcome, Tim. And
Thank you.
I'm excited because we get to talk about numbers and money today.
Yeah. I mean, for those of you who don't know me, I learned about real estate investing from someone who had quit his job as a car salesman and went full-time investing, right? So I've told this story before. I don't know if I detailed it on yours, but something you said triggered this memory for me. But so long story short, he quit his job as a car salesman, which is what I was doing at the time, to be a full-on investor. And I came from a background that didn't know that existed, right? Like, I mean, in theory, I guess you could say, but I was still in my mid-20s or when this happened. So it was just foreign to me that someone could do that or would do that, right? And so I started thinking about it, and I was like, well, I don't really have any money, right? I didn't come from money, didn't really have money. So I became a loan officer to learn about the money side. And off camera, a little behind the scenes, we were just talking about the importance of mortgage, and I think people think it's simpler than it is. And I'm not saying it's exactly rocket science, but they oversimplify it and overfocus on things that then have them either, in my opinion, make bad decisions and or might not move on something because of just like one data point, right? So like if the data point is a high rate, they might not buy a house, yet there might be tons of money to be made by buying at that high interest rate. In fact, I have purchased more properties in the last 2 years than I purchased the rest of my life combined. I'm talking small properties, not big ones. We've bought in some apartment buildings. I'm not counting those units, right? But if you're just talking about my duplex / single family purchases of my life or the last 2 years exceeds it. And most people have purchased less in the last 2 years than the rest of their life combined.
I love this. So what you're saying is the rate doesn't matter when the numbers work.
Right. And the opportunity is actually easier, if you will, or in my opinion, I think there's a lot of opportunity over the last 2 years. It's still there. And I guess I'm going to be here to kind of like ring the bell that if you haven't gotten on the train, now is the time. And I'm going to show you just a couple things to show you like how pent up the demand is. My theory, if you leave anything from this conversation today, is rate is important. However, you should almost ignore it in the sense of this. If the numbers are good enough to work, you buy regardless of what the rate is, right? That's what I mean by that, right? And make no mistake, get the best deal you can at the time. I'm not saying any of that, but there are so many other factors that make for profit, which is really what we need to talk about. You're not buying an interest rate. You're buying a house and you're only buying that house if it profits you, right? At least as an investor, you're not living in it, right? So where is that profit? And that's really what you need to be focusing on.
I love that you said this because everything you read and so many people are, oh, we can't buy now. We have to wait till the rates go down. You're missing big deals. Like you said, you bought more this year than other years. There
Yeah.
is deals out there.
The last 2 years combined. Yep. But
Yep.
still, it's absolutely. And I bought them different, right? I mean, I'm not here to blow smoke up anyone's tail. I didn't go out and buy a bunch of very standard deals. I had to look, I had to get creative, I had to force the issue. But we did, and I'm very happy with what's happened so far. And not all of those were long-term holds. I wish they were. I do love long-term holds, but we've got we used many different strategies to make it happen. We can certainly talk about some of that. I don't know that that's the focus of today's call, but I will tell you this. I have my first Section 8 rentals that I've ever had in my life because that was important to make deals work, right? I have mentioned this on other conversations we've had in other podcasts. Another thing that I think is important is that roughly every 4 years, your real estate investing strategy should be changing because the market changes, right? It's not the same. And if you try to just start throwing the same stuff up there, you're going to be less effective. You have to be fluid and roll with the market.
Yep.
And I think every other year, so roughly every 2 years, there's a tweak to that plan, right? So for example, the plan might be right now for me, Section 8 rentals, right? It kind of is, right? But let's just say 2 years from now, what could I project? Well, right now I bought 2 Section 8 rentals in St. Paul because I could find really sweet deals. That's not enough scale to really say that St. Paul is my current strategy. However, what might end up happening is 2 years from now, maybe that I have to shift to Minneapolis or I'm buying multifamilies, but maybe single family, maybe there's too much demand in a multifamily and I switch to single family, whatever it might be. My point is you stay with the market, you stay fluid, and that includes the interest rate market too, but you stay fluid and you let the market tell you what you should do. You don't try to jam your ideas on the market, right?
That is
no one
so
likes it.
true.
If I try to jam my ideas on LeAnn, you're gonna walk away. But if I go with if I have solutions and I listen to you, we can work together, right? And find the right path. Same thing with your investing.
That is so true. And you're right. The market does shift. It really does. And realtors who are out practicing and actually buying and selling for people, we actually have our finger on that. And, having a good realtor is really, really important and one who understands investments. If you're going to be an investor, a residential regular realtor isn't probably going to know some of the things that you need pointed out.
Right.
And for someone like my team, we just know things right away. Like I was in a house a couple weeks ago, it's under contract now, and I'm standing there with the client and I said, get out your phone. You need a picture of this electric box and of the sticker on the side. And he's like, okay. And he takes a picture and sure, we needed that information. You
Yeah.
have to have it. You might not be able to get insurance, but
Yeah.
if you didn't take the picture, well, how are you going to find out,
Right.
and actually to
So
win
true.
to win in multiple offers, we had to go with no inspection. That's why we needed the picture. We needed answers.
Yeah, and and I mean, this goes on to, there's a lot of different levels, right? You know, you said it right there, like to win, you needed to go no inspection. Well, you need a realtor to know that, like, yes, mortgage rates are high, but there's very low number of transactions, so there's still a high demand. And by the
Yep.
way, yes, houses are still going up in value, even with the rates as they were, right? You know, and you have to understand the market. How many times are people waiving inspection? How many times are they offering over list price? You know, appraisal gaps, all those other things. And I would say when it comes to investing specifically, what I see, because I work with mostly realtors who specialize in working with house hackers and investors. That's 70% of my business, right?
Yep. Yep.
And over the last year or two, it feels like it's even more, but traditionally it's been about 70%. So what does that mean? Well, I've noticed lately where our non-occupied buyers have actually been getting cash flowing deals in St. Paul. That's why I started looking there, right? Because
Yeah,
I
you
saw,
saw
where are
'em.
people buying? So where am I going to look? Where people are buying. Like, to be perfectly blunt, I really didn't want to buy in St. Paul. If you gave me my choice, I wouldn't have picked St. Paul. However, I did want a cash flowing property. And where were other people finding that? Well, I knew that because I see the transactions. Same
Yep.
with you. Now, if you go to average realtor who sells single families in Woodbury, they would have no idea that that's even happening, and they would just say, you know, John, Jane, whatever your name, you know, Jane, you really can't find cash flowing properties right now. They just don't exist.
But they
Well,
do.
I would agree it's hard to find them. Absolutely, it is hard to find them. But the right realtor knows how to find them. And if you are willing to, you know, dig in and try, I got the number one cash flowing property of my entire career. I closed on it less than one full month ago. You know, big old duplex in St. Paul, 10-bedroom duplex, 5 on each side by
Okay.
side duplex, you know,
And that was cash flowing like that when you bought it, right?
on a 25-year amortization at an interest rate of 7.05%. So
Yeah.
yes, you can cash flow at 7%. Is it easy? No. Is it possible? Absolutely. I'll give you the rough numbers. Okay. So here's the real rough thing of the situation. So we bought it. We're putting $40,000 into the property, probably end up being 50 actually, right? But like 40 is the budget. That's the hope, I think.
Yeah.
Right? And I guess it doesn't really matter what we're doing, but we're putting 40,000 into it. We financed that 40. So that 40 didn't come out of my pocket. I did put about, you know, I financed about 30,000 of the 40. Okay. So I'm paying about 10,000 out of pocket for that rehab. When it's all said and done, our mortgage payment is basically 2740. Okay.
Okay.
It's
All
like
said and
27.
done. Yep.
My rent on the first side that rented, 2742. Okay.
And now you got the gravy on the other
Yes.
sure. side.
The other side is the same size unit. We've had multiple applications on it. It is a Section 8, and we're being a little, I guess you'd say, no, I don't know, picky is the right word, but we're screening well, and we've went through a few people so far. We fully expect to rent the other side for another 2740, and we will be responsible for trash, water, sewer, and in this case, we'll also be responsible for electricity, both sides. Okay. Subtract those things off $2,740, and that'll be our gross cash flow before other expenses. Now, I know people will start telling me, oh, you got to deduct this, you got to do that. And I would say, in general, I agree when you're planning, you should plan on that. But I would also tell you this, if those expenses don't exist, you won't pay them and you will actually get that cash flow. Now, this particular property will be 100% remodeled. Every single appliance is brand new, never been used. They still have the stickers on them. And this includes the wash, everything, just everything. Okay. Everything brand new, roof new, windows new, everything's new. Will we have a repair? I'm sure we will. I'm sure we'll have a couple. Is that going to
Minimal.
be, yeah, is that going to be $2,000 next year? I kind of doubt it. You know what I mean? I think we'll probably spend $500, maybe $1,000 in total on the property in the next year. I bet you it's even less, really, but like I'm trying not to be overly, you know, I guess, I don't know, optimistic. So most of that money is going to be, you know, most of that, you know, we're probably going to make about 2,200 per month, you know, in cash
That's a
flow on this
lot.
property.
That
Now that'll
adds
go
up
down over
for
time as we have to repair more things, but yes, it adds up. It adds
That's a
up.
lot though. And that was with today's interest rates in today's market. There you
Yes.
go.
Yes. So
So that's
we haven't
why
even talked
I,
mortgages yet, have we?
yeah, but that's why, you understand much more than mortgage. You understand creative financing because you figured out how to just put 10 out of your pocket and the rest is financed.
Yeah.
And you could do the fix up rather than not do the fix up and get lower rents. See, it's all part of the formula.
Hmm.
Winning cash flow is what it always
Well,
works if you have winning cash flow.
yeah. Well, and what it did too is once I saw that, it opened my eyes to other things we had. And we had a flip property, and I started analyzing, and I'm like, if I do the same strategy, meaning Section 8 rental on this other property, how will that look? Well, I determined I'm probably gonna make about 1,200 a month on that one.
I
Again,
know.
fully remodeled. I wouldn't, not every appliance is brand new, though a couple of them are used, but they're all in good shape. And I'm not expecting any major stuff, right? And so I realistically think I'll make about 1,200 a month on that one. And that happened because my reticular activating system was triggered, right? I saw an opportunity here, and then I'm like, where
Wait
else
a
do I see
minute.
that opportunity? Oh my gosh, it was right in front of me. I actually already own the house.
I love that.
Right?
The whole portfolio I built, that 14 million, it was all on Section 8 inner city rentals.
Gotcha. Yeah.
That
So
is the theory. And I have taught many people that, and it still works today.
yeah, yeah. And I mean, this is our first foray. It's been interesting. Yeah, it's different. It's different, but we're ready for it. We've been landlords
You're
self-managing for
seasoned.
quite a long
Yeah.
time. Yeah, I mean,
Yeah.
decades, 15 years. Well, not decades, more than 15 now. Yeah, 19 years. So
Wow. Okay, cool. I love this, you guys. It's possible. That's what we're here for.
it's
And
possible. Yep.
it's proof. So today with okay, so we had a little lower rate. So what's today's rate? We're
Average rate. I like to use averages, right? Because everyone
okay,
qualifies for a little
averages.
different.
Yeah.
And this is not investor specific. This is actually more like owner occupant. Average rate today on a 30-year conventional fix is slightly more than 6.1. It's actually 6.118 if you want to get really specific. That's
Okay.
just an average, right? No one
And we're
actually gets that
talking
rate.
September 2024, just so
Yeah, September 25th. And that's kind of important because if you went a week back, it was actually sick. It was actually it was about 1/10% lower a
yeah.
week ago. And I can explain why that is. And there's no need to panic. It's actually was expected. Us internally, we had been talking about that. I want to go back 3 months just so you can get an idea. 3 months ago, it was a little over 6.8. So we've come down 0.7% in the last 3 months. That's a pretty big drop, but it happened slowly. That's what you didn't see these like tons of things in the news. The news media gives you what they can understand and what they can push out there very quickly and very simply. So they hear the Fed drops rates and they just kind of all of a sudden they notice mortgage rates are lower and they say mortgage rates dropped. Well, no, they've been dropping for 3 months. Okay. And you just don't hear about it. Okay. They drop much slower than you would ever guess, and they raise much faster than you'd ever guess. That's just kind of like the way the system works. And there's a reason for it, but I don't want to bore you with everything or give you everything today because it would just be overload. But one thing that happened that no one expected, and the day the Feds dropped their rates, my rates went up that day. Okay. And so did every other mortgage guys. And there's a good reason for it. So I got all these calls from all these excited, past clients going, mortgage rates are dropped. What can I do? And they're thinking they're down a half point. And I'm like, actually up slightly, but just a little bit. And here's why. So mortgage rates are mostly affected by, negatively affected by inflation. But they're also slightly negatively affected by what happens in the stock market. And if you have been paying attention to the stock market since the Fed dropped its rate, the stock market's been on a boom, right? And so the stock market goes up when businesses have a better outlook, right? And businesses have a better outlook when they can borrow at less money and their consumers can borrow at less money. And the Federal Reserve rate affects things like your credit cards, all your short-term rates, your credit cards, your home equity lines of credit, your car loans, those sorts of consumer loans and consumer activities, plus the money that businesses buy it. So this was huge for business, which means it's going to temporarily at least give this kind of a spike in the stock market. And when large institutional investors, I'm not talking about LeAnn and I, but I'm talking about like when the Teachers Pension Fund of Canada, the second largest investor in our mortgages, decide where do they want to put their, $100 million this month that they're going to invest, or they're going to move around. They have much more than that, but their discretionary money, where are they going to put it? Where they're going to favor stocks right now instead of bonds. That means less demand for bonds. And anytime there's less demand for bonds, the bond coupon, the interest rate that the bond pays its investors, must go up to attract more investors, right? Well, that's just a fraction of your mortgage rate. You take this bond coupon, you add on for the secondary market, you add on for this, and then you add like the servicer, and then you add on for our company, and here's your rate. Okay.
Yep.
But the underlying factor, the biggest cost in that mortgage is what the bondholder getting. Well, they're getting a little bit more, 0.1% more right now than they did a week ago. In a week from now, I think it'll be about the same as it was, or maybe even a little lower. This is not going to take very long to go back down, but it is a temporary blip.
Yep. And so, is there new programs or something then now to also, is there new stuff out to go with? Ooh, the rate's lower now. We have this new special.
Ah, there are, but if I could actually, I think before we go there, one more thing. I think I'd love to tell you about the demand that's happening right now, because I
Yeah.
think this is
It's
just an
crazy.
insight. Yeah, like I told you, there's a real pent up demand, right? And if you look at what happened in the last week, mortgage refinances have increased 20% in 1 week. Okay. It's a
Wow.
big
That's a
increase for
lot.
us. It is. And really mortgage rates didn't change. All that changes people's perception of mortgage rates. They actually went up 1 week over the next, but 20% more people bought. What does that tell you? I can tell you what it tells me. It tells me it's very validating of things that I said the last time we talked. It was that people weren't buying because of confidence, not because it wasn't a good deal. The underlying fundamentals is we are so incredibly short on homes. We're not building enough, and it's not even close. It's
Yep.
not even close. We are probably millions, but for sure at least 1 million homes per year less than we need to build. And people look around and they go, oh, they're building everywhere. No, they're not. Go to a baby ward and tell me if they're building everywhere. They're
Right.
not. They're not building enough for the number of people we have, and the number of people who are coming in the country, and the number of houses we need. It's not even close. So what does that mean? All you have to do is a perception change in the rate, not an actual change in the rate, and
Yeah.
things bump 20%. What does that mean? No, think of that as an investor. That means that if I buy a house now and rates actually drop to, let's say, 5.5, what is that going to do to my investment? My personal belief, this is my prediction, and I'm willing to go on tape. You're going to send this out to everyone. I think what's going to happen is roughly 6 to 8 months after mortgage rates drop considerably, you're going to have a 10% appreciation in the following 6 months, right? So there might be a couple month lag, because when rates drop, it takes a little time for buyers to then all of a sudden go to their loan officers, get approved, go to their realtor, start looking, find a house, get under contract, right?
Right. And
Um,
close.
yeah. So I think really what happens when I'm talking this 10%, I think it's 0, 0, 0, and then it's 1% per month, 1% to 2% a month for like 3 or 4 months. And next thing you know, that $350,000 house is going to be 385, maybe even 400. It's going to be, people are going to be shocked, almost scared. Like, they're going to look at houses 1 week, the next week they're going to have to lower their search criteria by $15,000 because they're going to have to be able to bid that much higher just to get that house, right?
Yep.
And then the month after that, they're going to go down even more just so they can bid $25,000 over asking price to hit the right from their max.
And that's all driven by the inventory shortage, which people, I mean, I've been talking it, you've been talking it for several years. It's not going to change. That does not change fast, and it's not going to. And the population is growing, like you said, and it's a problem that won't get fixed for a long time, folks.
Yeah. Yeah, because the interest rates affect builders quite a bit more than a consumer. It's actually worse on them. They pay much higher rates than we do, and they have to hold these houses for long periods of time. And if their houses aren't selling, which I think one area that's been really soft, now I said housing pricing went up, new construction has been soft, right? They've given a lot of incentives. They subsidized a lot of rates to get people to buy,
They do.
and they had to
Yep.
do that to keep moving inventory. part of that's because they only can build one type of house profitably, right? And that is an expensive house. A big box in the suburbs, that's pretty damn expensive is about all you can build and make money on. You know, you try to build in the city or anywhere else, and you're just not going to do it. You know what I mean? You're just not making money, at least not at scale.
Yep.
So anyway, so I really feel like this is the warning sign. This is the warning shot. Look, I don't think housing prices are going to skyrocket in the next couple of months. That is not my prediction. When we need something more to have them skyrocket, but I wouldn't be surprised if you've got from now until like maybe April of next year. I don't know that that's a month. That's certainly not my prediction, but that feels about right. Between now and April, if you haven't went in and gotten serious and bought, you're going to be disappointed in yourself. That
It's
and
going to
I'm
go, exactly, and I would agree with you 100% on that, because you're right, the prices are gonna go up to meet the demand, and there you are, you're better off at this higher interest rate that we're looking at today.
Mhm.
You
I'm gonna
know,
buy as many as I can. I don't know that I'll get 6 in that time frame, but that's I'd really like to get one. I'd really like to get, you know, 1 a month in the next for the next 6 months. And probably what that'll look like for me too is like we just kind of have 2 that we're trying to rent out. That'll probably look like 0 for the next 1 or 2 months, and then I'll try to get 2 or 3 in a month and, you know, try to
yeah,
catch up, but
because
I absolutely think this is happening. Yeah,
totally,
yeah.
totally.
Okay,
So,
you asked me a
it
question and I kind of deflected and I didn't mean to. I just kind of wanted to get that part done
I
with.
think
So
that's critical. That's a great, it's the prediction, but it's what's going to happen. And we have, you've been around, I've been around, we've seen this before.
yeah.
It does
Oh
work.
yeah, speaking of which. Oh, there's one other point I have on that, and this I have to share my screen. So this is definitely really geeky when it comes to the market, but also really important. So I'm gonna share my screen and I'm
Okay.
gonna open up I'm opening up a screenshot. This is about recessions, probably not super critical to you, but mortgages do wonderful in a recession, right? And when we have a yield curve inversion, which you've heard about, recessions typically follow, right? So far, there's never been an exception to that. So this is how long after the yield curve, the inversion ends. The inversion just ended, by the way, which means that it's now true that long-term rates are pay better bonds and more yield than a short-term rate. For the last several months, I don't remember exactly how long, so I don't want to say the wrong number. For the last several months, I think probably at least probably close to a year, you actually made more on a short-term rate than you did on a long-term rate. That's
Yep.
no longer true. When
Yep.
that flip-flops back to normal, there's usually a recession. Sometimes you're already in the recession and don't know it, but it can happen anywhere from 10 to 13 months later. If that does actually end up becoming true, that's going to be a big driver of mortgage rates down. But the other thing I want to show you, and this is actually probably even more going back to our last point, what happens when the Fed starts lowering its rate? What typically happens to rates? Well, they go down about 1.3% from the peak. So what that means is if the peak was about 7%, you could expect 5.7 as your typical rate. Now we were already when they started doing this, we were already down a little bit. Most of the predictions I'm seeing are actually closer to 4.7 and not 5.7 for a low, meaning that once it hits that, we're not really expecting. There's no reason to expect it's going to keep going lower than that. So I think that we've got a lot of room to run. Interest rates are going to go down, and as they do, the value of your investments are going to go up. But it's also going to be harder and harder for you to find a property to buy. So buy now before all the people start rushing, right?
Yep.
That's my big point, and there we go. So I'm
And
off my
another
soapbox.
one, a lot of people are spoiled at the 2.7 and the 3.5 or the wherever it was when it was. But that's not going, forget about it. It's over. We're not going to fall to that. If you're going to wait for that, you're going to be waiting a long time.
Yes.
Yeah.
Yep.
So figure
Yeah.
out how to buy with the current rates is really the whole point here. There is ways that it works, but you better know your numbers, right?
Exactly. Yeah, absolutely. You can't get, I mean, yeah, no one's saying get loosey goosey. No one's saying buy just to buy, right? You've got to buy the right one and you've got to put in the effort. But the effort's actually not nearly as bad as it will be if rates do come to 4.7. Holy cow. The
Yeah,
effort's going to be how much over
then
asking price do I
the
bid?
prices will go up worse. Yeah,
Yeah.
totally.
LeAnn, if I bid 40,000 over, do I have a chance? That's what you're
Yeah,
going to be saying.
yeah.
How do it?
And I have
There
to
will be
forego
zero
the
inspections.
inspection and,
Yep. Yep.
practically show up on the doorstep with the cash.
Exactly. Yep. You'll be buying from me. No, I'm kidding. I'm not. Hopefully, I won't be selling too many. That's not my goal. But I mean, sometimes you have to sell some to make up money, to unlock capital for another deal, right?
Right. And sometimes, especially when it's a better deal, then
Yes,
that's when you let go of something.
exactly.
So as far as the refinancing is, you said it's perked up, but for investors, I know it's been a little bit tougher because they want, is it 75% loan to value? Is that the number now? So
It depends on the loan program, of course, right? So I would say the loans that most people use, if you're talking multifamily, it's 75%, right? Um, Single family is going to be a little lower at 80 on a refinance, that is not, and I'm talking
owner
conventional here.
occupied, single family.
Well, if you're okay, no, owner occupied, you can refinance 95. Yeah.
Oh,
And
okay.
actually you can do FHA even higher, right? But I don't think many people are going to be refinancing FHA. Well, yeah. Okay, so first off, if you have an FHA loan and you get an FHA loan on duplex, here's a benefit. Even if you move out, you can get owner occupied rates on your duplex when you move out. So that is one benefit. Like everyone else trashes FHA, it gets a bad rap. It's an incredible loan for an investor. Nearly every investor should have one FHA loan in their life, if not a couple. Um, but there are advantages. So here, what one of the things you would ask is like no mortgages. There's more to it just than what's your rate. What are the other benefits? And that would be one benefit to the program. It's really beneficial because for a lot of people, and I know some of this is going to tie into something we talk about later. For a lot of people, when they know that when you buy a house, you have to live in it 1 year, and then they think you can move, but the reality is if you refinance that, your time period starts over again. So you could have purchased, lived in it 7 years, refinanced. You got another year before you have another owner occupied loan, unless something strange. There are some exceptions to that, but let's not get into those, right? So what's the advantage to this FHA then? Well, you could have bought a year ago. You could move out for 3 years and you can still get an owner occupied refinance on a streamlined refinance. It must be what their streamlined transaction. You're not going to do a full refi. But that's a sweet deal. It's an easy deal to get. It's an easy little deal for a lender to do. So we're really competitive on price. Like a lot of lenders have special programs where they slim their margins down a little to get those deals because it's
Sure.
easier to get, right? So the bottom line is that's an advantage of FHA. If you have it, you should take advantage of it, you know, and but maybe you wait a little while. I personally am not encouraging my clients to refinance now. I think it's premature. I think that a lot of people are refinancing now or jumping the gun, but good for them, right? I mean, everyone's situation is different. Maybe they want to move within the next year. Then I would be telling someone called me and said, I want to move in a year. I'd be like, refinance today because that starts that clock. You know what I mean? You've actually got 13 months because it can take us a month to close. You know what I'm saying?
Yeah. And
Yeah.
see, I think what that says is definitely, work with a mortgage person that you can call and help plan with, especially if you're into investments. You need to plan just right for taxes and other
Mhm.
reasons how that might look, that mortgage.
Yeah, you want to plan how much you do claim on your taxes and where you claim the income, right? And where you claim the deductions.
Yeah.
The fields that they come in matter to some extent too.
Yeah. For you getting people qualified to buy more.
Exactly.
Okay.
Okay.
So we're both agreeing it's the perfect time to buy. And, did any guidelines change lately or anything? Is it as easy as always, depending on it's your credit score,
Yeah.
it's your income. All of that is what determines.
Yeah. Basically, guidelines are the same. There was actually a very recent softening of self-employed guidelines on a Freddie Mac loan, but Fannie Mae hasn't followed suit. So really tiny changes. They're, they would help some people. No, it's been a very long time since it's gotten harder to buy a mortgage. They've
Okay.
been slowly tweaking them to make them easier, but we're nothing earth shattering here. And I would say that like it's very possible that that most recent kind would affect no one on this call. It's going to be just a minute number of people out there that that particular thing would affect.
Yeah, so
Um,
nothing, it's still kind of business as usual, let's put it that way.
Yeah, absolutely. What has helped, and this is from an investor point of view who's selling homes and maybe even flipping homes in low income and low price points. The state of Minnesota in particular came out with a cool program that's really important. I'm sure you're shaking your head. I'm sure you know it's called the First Gen program. And what that
Yes,
means is if you're a first generation home buyer, you can get an additional $33,000 above and beyond the normal eight. Well, they offer a couple of different things, but up to 18,000 there, right? So 18 plus 33 is what, 51. You can get up to $51,000 in down payment assistance to buy a house.
that's
Um,
huge,
I've yeah,
huge.
I've done 3 of those this year. Now that money, for the record, is disappearing fast. I mean, the word got out, and it's not unlimited funds. However, there, last I heard, there's still money available, and that's a great program to help people. And if you get an offer on that program, I encourage you to accept it if you think it, everything looks good. But that's a program that's out there. Fannie Mae and Freddie Mac have also done some things, I guess, to make it a little bit easier for certain first-time homebuyers to buy homes too. So, I mean, again, we're talking about like real little tweaks, but the bottom line is nothing's gotten harder; it's gotten easier.
That's kind of cool. And but there's really nothing much new for investors. There's the DSCR. Explain that loan just for people.
Sure, yeah, yeah. I think it's fair to say there's nothing new, but there's a lot of things that maybe people don't know. That
Yeah.
DSCR loan is one. So here's what's new on DSCR. DSCR, if you were to come to me like last year when we talked, my guess is the first digit on the interest rate would have started with a 9. Okay. Unless you had massive money down, right? But I mean, most people don't come to me and say, "What's the most I can put down on my investment property?" They usually say, "What's the least I can put down on my investment property?" And they're still putting down anywhere from 20 to 30% on a lot of
Yep.
these loans. Okay,
Yep.
so DSCR loans look to the property's rental income in relation to the mortgage payment. Most of them calculated this way, so I'm going to tell you this way, but there are a little that are different, right? Most of them will take the rents on the property, and then those rents times 0.75 must be equal to or greater than the mortgage payment. So whatever your lease is, 75% of your lease has to be equal to or greater than your mortgage payment. Some of them will actually take the full rental value, and some of them will approve you if the rent, many of them now will approve you if the rent is below 1-to-1. So meaning that like usually this comes up in short-term rentals or whatever. You might want to still buy the property if the mortgage payment is, 3,000, but the rent for a long-term rental is 2,500. They won't use the short-term rental in most cases. They'll only use the long-term rental rent. You're actually expecting to make 5,000 a month, so you're okay with it, because you're still planning to make 2,000 a month in that scenario, even though on paper it looks like you're only going to make 2,500. So that's a DSCR loan in the nutshell. You don't need to have personal income, and they're pretty easy. Now those loans are now very much in the sevens. Okay. In fact, I haven't priced them out in several weeks. There might be a situation if your cash flow is like, so on a if your payment's $1,000 a month, your rent is 1,300, you might very well in that situation get a rate in the sixes. You
That's
know,
really amazing because they were in the nines, like you
yeah,
said, and
yeah.
but yet it still is another way for someone, maybe they're self-employed or whatever. It's another way to buy.
Yeah. And there are a lot of lenders out there. So what I just gave you is a very generic view. I do know exceptions to about everything I just said. I
Well,
just
there,
didn't want to set the wrong expectation for the general market.
right.
But there are ways to tweak all that stuff, right? Including like if you put more money down, which I generally don't recommend, But if you put more money down, then you can end up with a rate, you can end up with a rate in the sixes and on those loans for sure right now. Cause I've quoted some of it.
Are
You
those
could also,
30-year mortgages though? No, they're shorter term, right?
no, those are 30. Yeah. They don't do
Oh,
any, they're 30-year mortgages. The biggest downside to those in my eyes is they all have some form of prepayment penalty on them. In the state of Minnesota, most of them will waive them, but then they charge an extra addition of the rate to waive it, and that bumps the rate up. You know, that's tough because
so there's a cost to refi out of it, is what you're saying.
yes,
Okay.
exactly.
Oh, we have a question. Can you see that?
Yes. Eric asked, can you get a DSCR loan for a property that you're planning on renting? And the answer is yes. Now, first of all, in the state of Minnesota, it's actually illegal to not verify their ability to repay on a primary residence. That's a long way, that's a mortgage guy speak for saying you have to prove your income if you want to live in the property. It's actually illegal for us to do a loan if you don't. But
Oh,
if you don't live in the property as a business purpose, then we don't have to verify income. So I would say this, Eric, you have to plan on renting it. If you're planning on moving in, I can't do a DSCR loan for you, and no one legally can do a DSCR loan for you in the state of Minnesota.
but an investor, to answer his question, can buy a single family townhouse, condo, whatever.
Yep, I know there's DSCR lenders that will do multi-unit, including above 4 units, so that is totally possible. Um, Eric asked how you verify the rents. Most of them, again, some of them get a little creative on this. The overwhelming majority will use whatever the appraiser says the rents are. But I've seen other lenders who will say, or if there's already a lease on the property because it's already a rental, that would be another way. And then some of them will let you use rental projections. They're usually the more expensive ones. Again, there are some little tweaks where they'll say, well, we're a little different than everyone else, and we let you do this, right? Typically when they do that, that comes with a cost. But if it gets the deal done, again, interest rate's not the only factor. If you're gonna make, let's say, $400 or $500 a month in cash flow, but you're also buying a property that you're getting like a little bit of a deal on it, like because it's a little distressed or whatever else. Maybe you're picking up, 5% in equity. Maybe you're making $500 a month. If your rate's just slightly higher, who cares? You know what I mean?
Yeah. I mean, exactly. And especially like you say, you better do it now than 6 months from now.
Yeah,
It'll be
exactly.
worse.
Yeah, yeah. So, the other thing that people don't normally know about, these are not new at all. They're really old loans, but people don't know about them. So it's worth mentioning. And you mentioned my wife brokers commercial loans, and I just asked her banker on Monday what the commercial rates start at. And for their ideal loans, their perfect loans, they're starting at 6.5% with 25% down. That's not 20. 25% down is 6.5%. It must DSCR at 1.3 to get that rate.
Ooh,
That's a 25-year
1.3.
amortization, and that's a 5-year fixed rate. After the 5th year, it will, in their case, I think it balloons. Some lenders will adjust once and then balloon at the 10th year. I think theirs all adjust at that. But their prepayment penalties are only if you refinance with someone else. There's not, if you refinance with them, pay it off in cash or sell it, they don't charge one. So it's a really soft, very, very customer friendly prepayment penalty. So I mean, if you wanted to just put 20% down and you had a really nice cash flowing property, the rate would be 6.75. And if you didn't have a great cash flowing property but good enough, it would be 7%, which on an investment property
That's
is
not
an
bad.
awfully good rate right now. Yeah.
Yeah, that's
That's what I did.
awfully,
That was mine, that's what I did,
yeah. It's good to know a commercial. You have to look at all the options.
Yeah.
And like I said, I've sent you people and then the options didn't look good and you've sent them over to commercial to, you got to look at all the options, which one then works best.
Yeah, exactly.
Yep.
All right.
Okay. So, what about buy down? Say something about buy down. Are people buying down the rate still?
I'm kind of recommending it for some of my owner occupant buyers. So again, kind of going back to everyone's situation is unique. I'm generally not a big fan of buy downs. I probably have tracked more often than like them. But right now I see So right now what we're seeing is rates are kind of bunched close together where the cost to buy down to get like a full percentage point higher can make sense in certain situations. And here's where I see it making sense most often. And in most other cases, I don't like it. Okay. So if you're buying an owner occupied duplex to live in one side, rent out the other, and you think you're going to try to buy a new property in 2 years or less, you're going to have a hard time refinancing that for the reason I said earlier, where you have to wait a year after, right? So, because if you want to move a year from now, well, you won't be able to refinance at all, right? And we don't know that rates are going to be at their low 1 year from now. It might be a little longer than that, okay? If that's the case, then you would be out your refinance and you'd be stuck there as is, right? So a refinance costs money. If you came to me and got a refinance, obviously it depends on your thing. It's pretty safe to say that most refinances cost $6,000 to $8,000 in true cost, right? That's not that uncommon anyway, right? It's very dependent on the situation and very dependent on a lot of factors, but that's a very safe range to talk about. Well, if you could get that rate or a rate you're happy with, good with, for $6,000 to $8,000 today, you start to save now and you cut out the need for the next refinance, right? And so in that situation, I like it. In any other situation, if you told me like we're planning on buying here 3 years or longer, I'm saying I think you'll get a better deal by waiting. I think I think that $6,000 to $8,000 will get you a lower rate than I can get you today. But to put it in perspective, today it depends on a lot of factors, but with a good credit score, buying a duplex, not a single family, because duplex rates are a little higher. If you bought a duplex today and you had the seller pay 3% towards your rate, 3% of purchase price on a 400,000 house is 12 grand, totally doable. If you can get them to do that, you could have a rate of 5.25, 5.375,
Yeah,
something like
have it bought down by the
that. Yeah,
seller.
yeah.
That's different. That's their money, not your money.
Kinda, yeah. It's in lieu of discount, but it is. I mean, and you're saving right away and you're skipping that refinance.
Yeah,
To me, that makes some real sense. And it kind of frees you up to just go for the next one.
yep. Now, let's talk about over leverage because, investors, what they want to buy that another one or three or four like you're talking about, but they don't have the down payment money. So that's why they're going to maybe refi their other investment property or put a HELOC on their house or something. You know, what's your theory on, that's a good idea sometimes, but sometimes it's not.
Yeah. Um, I uh I have a controversial theory on this. I think there's really no such thing as over leverage in residential real estate. I think that's important because in commercial, there absolutely is. It's a totally different ballgame because those loans, the value of the property changes based on interest rates, right? So and they balloon. And the combination of the two can make you can
Yeah.
absolutely be over leveraged in those. But on
Yep.
a residential transaction, your value your property doesn't fluctuate simply based on the interest rate. And for the most part, they don't balloon. Now, if you talk to commercial rates, they will balloon some. But you still don't have the same valuation difference that you see in commercial. Like, for example, rates are high, we're still seeing values go up in residential. Whereas in commercial, they're dropping like a rock. Okay.
Yep.
If you understand that caveat, it's almost impossible to be over leveraged, but I see most people undercapitalized. And what's the difference? In my opinion, most people want to be leveraged less because they feel like their property is going to cash flow more, or because they feel it's safer. Like their parents tell them, like, "Oh, you should put more down because you'll have a lower payment." Oh, and of course, a lower payment's better than a higher payment, right? Well, not exactly, because you're trading dollars to get that lower payment, right? If the dollars are unlimited, I would say, okay, I would go with you. Yes, a lower payment's better. Okay. But when you have to decide, when you're talking about where am I going to allocate my cash and where's it going to do me best, I think it's almost always worse to put it in your mortgage. There are exceptions to everything. I can think of a few, but for the most part, keep it out of the mortgage, keep it in your bank and invest it somewhere else. Example number one would be this. First, you have to understand how much do I save if I put money into my mortgage? And the rough rule of thumb lately has been about $7 per thousand. That's dropping pretty quickly. It's much closer to 6 than 7. But let's just use 7 because that's actually a more conservative thing. That means if you put $1,000 in, your payment goes down 7, 10,000 goes down 70. So if you came to me later, or if I said to you, LeAnn, that like, okay, LeAnn, 1 year from now, your tenants are gonna, you bought a duplex, your tenants are gonna stop paying, the water heater is gonna break, and a furnace is gonna go out all at the same time. Would you rather have a payment that's $70 less a month, or would you rather have $10,000 in the bank?
10,000 in the bank.
Right? And I think the same thing's true if you're talking about a multi-million-dollar apartment building. We have apartment buildings where the payment's $21,000 to $23,000 a month. Okay. Saving $700 a month because I put an extra 100,000 down. 100,000 sounds like, oh my God, put $100,000 down, your payment's so much less, right? No, it's $700 less.
Yeah.
700, that's it. Our rents, that doesn't, our one apartment for us rents for more than $700 a month. It is meaningless, absolutely meaningless. But that $100,000 is a big deal when you're talking a $23,000 mortgage payment, and let's say 4 tenants don't pay you that month or whatever,
Right.
it
You may need
matters.
it.
Yes, you may need it. Yes. All kinds of things. Someone smokes in there. We had 2 apartment for this is years ago now, pre-COVID even, but we had 2 apartment fires in 1 year. People smoking in their apartments. You need it.
Yeah. Yeah, you need it. So that's a great way to put it, that because cash is king.
Hmm. And what did that other $10,000 do for you? Because it's not just that. It's also what. Let's talk about profitability a second, because people always forget this. So you got this $10,000. You can save $70 a month on your payment, or you can buy a property that needs $10,000 worth of remodel. And if it needs $10,000 remodel, it's not getting top rent. I can make up whatever number I want, but I think it's pretty fair to say that if I took a unit that needed it and I put $10,000 in, I could get new flooring, I could get new lights, I could get new like hardware, like doorknobs and knobs on the kitchen cabinets. I can get new paint everywhere. I could probably put in a new vanity in the kitchen and maybe some new faucets. And that's probably about it for $10,000. Maybe a little more, but roughly. I think if I do that in a place that needs it, I'm getting about $200 more per month. So 70 or 200.
200.
One of those doesn't affect the value of your property, nor how easy it is to rent or the quality of renter you get. The other does. Where's the money better spent?
Yep.
I can think of very few situations where it's better to put the money in the mortgage. And most of it has to do with the person's personal financials. And a lot of times that 10,000, it has to be just throwaway money. Like they're not buying another rental ever. There's no rehab needed. This is just purely extra cash that's better in the property than it is in their bank account. And that means they better have a lot in their bank account too, because what's $70 a month or foreclosure, right? Because if S hits the fan and you've put every dollar you have in your properties because you're trying to save a fraction of mortgage interest every month, you are riding a dangerous line.
Yeah.
Way more dangerous than financing maximum dollar.
Yep. Yep.
Anyway, I could talk about this for a long time. I'm super passionate on that subject.
That is really good. So, let's see. I think you covered this because I believe buy and hold is the ultimate path to passive income.
Yeah. Yeah, I love buy and hold. It's been most of my career. I've floated around. Personal needs have changed for me. So some of that has meant that I've needed to do some flips, right, to build up some cash.
Yep. I know lots of people who do that. You flip in between to get more
Yep.
cash.
Yep. Yep. And a lot of that has to do with the mortgage market. There's not a lot of transactions. So I'm not building it up for my day job. So what am I going to do? Well, I believe in buying properties right now. I could either sit and cry about it, or I can go flip a property and make some money to go get one, right?
Yep.
Yeah.
That's a true entrepreneur right there, because yeah, market shift in real estate, same with me. And that's why I have coaching. I can vacillate between the 2 or
Mhm.
3. There's other ways to make money in real estate, but it's all part of being super educated and, working with other experts.
Yeah,
It really
for
is. And
sure.
building a team, I know that's another whole thing, but a team of people, because you're not out there flipping and pounding nails or anything. You're just coordinating it.
Right,
Yeah.
right,
That's
exactly.
why I mean a team, but you have a team that can do all that.
Oh yeah, I've got at least 4 or 5 people right now working on a property, you know?
Right. Well,
Yeah.
you're here.
Yep.
Okay, so we want to wrap it up. Um, so, what's really great is you figured out, you know all there is to know about mortgage, so you can really crunch those numbers and move that money around. And that is part of the game of smart investors. You're moving your money and watching, like you said, I really like the pointer you put about markets change and you got to tweak your strategy. It's not all one, oh, I'm just going to do this one thing and do it for 20 years. It doesn't work like that. There
Yeah.
is changes. Like, and COVID is a great example. Everybody's life changed. And landlords had to change what they were doing. Everybody had to change. But that's why I like government subsidized housing.
Mhm.
Always have liked it. It
Yeah.
works. And, even when you go out of the area to smaller towns, there's a need for affordable housing everywhere.
Oh, absolutely. And
Everywhere.
again, it's that need is gonna increase due to, well, so many reasons, right? But, like, not the least of which is just we're underbuilding houses and we have for a long time.
Exactly. It's increasing and the cost of living and inflation and all
Yep.
of that other stuff.
And if you can only build multi-million dollar, well, not multi-million dollar, but like if you can't make money in the Twin Cities unless the home start purchase price starts at like 500,000, you're not building affordable housing, right? I mean, so there's so many factors. Yeah.
So now you said, I thought you were going to give us a link where someone could look at
Yeah.
what I want you to throw that in the chat.
Yeah. So save this link. So there is a software owned by BlackRock. If you haven't heard of them, they're a big company. They
Yeah.
they have a mortgage software they purchased that is used to lock 35% of all US mortgages. So where I go to find out if my rates are competitive is this site here. Because you can go to LendingTree and get lied to and misled and get a rate that's significantly higher than anything you ever see published on their website or any other site like that, right? I mean, you can add Zillow in there too. Anyone who's trying to get you to click on their website is giving you a fake rate. They're giving you a rate that if you're a multimillionaire and put almost borrow, 50% of the house price and have the perfect credit score and this and that, that you could maybe get that rate when the wind's blowing, right? Or you can go to this site, which actually tells you in 1 day behind what people actually, 35% of the population lock their rates at on average,
Okay.
right? It's not perfect for an investor because it does not tell you what an investor's rate should be. We're talking about owner occupied homes here, but you can still very much get a gauge
Yeah, I
of what's
like
going
that.
on.
So thank you for sharing that with me.
Yeah,
Then I'm going to wrap up. I'm going to share screen real quick here and show you how
sure.
to contact Tim right here. My alarm's going off. Okay, so there it is. Is that the right number?
That's right number 651-772-9000.
There you go. Perfect. Gold
Um,
Star Mortgage. And Tim is really great. If you have a mortgage question, call him. He will tell you the lowdown. You can tell.
Yeah, and if you want to talk investing too, my passion, as you can kind of see, is I mean, I really feel like I should be a coach now because I really love helping people make money doing real estate, not just getting a loan. So that's really what I like, and I'm happy to help people. Now I don't charge for coaching, so I do want you to do mortgage for me if I help you, and I feel like my advice is worth way more than any cost difference between me and the next person down the street.
And that's what Tim and we met and we collaborate, let's call it. And I love that because if I have a mortgage question, I know who to call and I can
Mhm.
get a straight answer. And I have people on my list that I refer. Tim's
Mhm.
on the list. I refer people that I know can answer anybody's question. And being an investor yourself really helps on that investor side because you know the angles.
Yeah, and I didn't ever think about this, but we're here in Minnesota, but I forgot you have a nationwide audience.
Yeah.
So I also lend in Texas, Tennessee, Colorado, Arizona, Florida, Alabama, and New Jersey.
Wow.
Oh, in Wisconsin. Yeah.
Oh, okay. So that's quite a few. Exactly. And that's good to know too, because a lot of people are buying second homes in some of those other states.
Yeah. Yeah.
Okay, then I got to show you how to contact me. Oh, I got something new. I've been coaching people for many, many years here, but I launched, I guess we'll say, a starter program. It's 7 weeks. You get coaching and training, and you get the proven profit formula structure. That's my system of how I built that $14 million portfolio. It's a 7-week program. Pretty easy to get yourself through, and you will have the guts that you need to be a smart investor. So I just want to tell you about that. You can find it on my website, leannriley.com/coaching, or there's a QR code right here. So I'm going to wrap up, and I think we answered all of our questions. So thank you, Tim, for
Yeah.
joining me today, taking the time out. And I know I'll be talking and see you again soon, but thank you for answering all those questions, because mortgage is confusing for many people.
Yeah, absolutely. And it is. I think it's confusing because they think that, well, it just is, right? There's just reasons
It
to,
just is. It's
it just
not
is.
something they do every day, the same as us about real estate. This is why you need a good realtor. You don't do it every day. We do it every day. We have run into every situation, and we run into new ones all the time, don't we?
Yes. Yep.
Anybody
And
in this business, I'm telling you, it's not the same. Even though it's been many years, there's something new all the time. Like realtors, we have the new NAR settlement. We're still
mhm,
trying to figure that all out.
yeah, and the first generation program, the way that works is anyone who gets that program has 3 different loans at one time, just the way
Ooh,
they structure it. They're not necessarily paying on 3 loans, for the record. I don't want to scare people, but that's just the way the money works out, right? And just completing 3 different loan packages and where we need to put the fees, because there's fees. You still have to record the loans, even though there's no payment due and stuff, right? And how you record it and how you do it, it's stuff changes, right? Like you said, and it's all a little different. So even for
does that loan have to be paid back if you sell the house or over time? I'm curious. I don't.
so the 33,000 is forgiven. The first half of it's forgiven after 10 years, and the second half after 20 years. So if you live in it 20 years, you never pay it back. But if you live in it 11 years in 20 days, you pay it all back. I'm sorry, 10 years, 9 years in 20
Oh,
days,
9 years.
because
Oh,
you
then
have
you
to
pay it
cross
all.
that 10-year period to get any of it forgiven. It's not like they forgive a portion each year.
But
It's 10 years and 20 years. That's it.
I still look at it as free money, in the sense of you're not paying a monthly payment on it.
Oh yeah. Yeah.
That's that's amazing.
Yeah, you're borrowing someone else's money for an undetermined, and you get to control how long.
Yeah,
Yeah, that's an awesome deal.
that is. And the funny thing is, because I work with a national audience, I thought that was everywhere because I happen to live in Minnesota and we have it. And then I found out, oh my God, it's not.
No, that was set up
We
by the state. Yeah.
Yeah, I was like, wow, that's pretty amazing, because I had another guy looking for it out in Jersey, and he's like, I can't find it." And I'm like, oh, it's a Minnesota program. So
Oof,
anyway, thank you, Tim,
you
for
bet.
your generosity and time.
Happy to help. Call anytime.
Okay,
All
we'll
right.
talk
Appreciate
soon.
it. Yep. Bye bye.
Okay, bye-bye.